Should I get started?
Yeah.
Hello, everybody. Welcome to the Home Run podcast. I'm your host, Alex Sendek, and today we have a bit of change of scenery. We're at Beeline headquarters here in Providence, Rhode Island, and with me today I have our guest, Bella. She is our HR specialist. She wears many different hats at our company, and today we're going to be talking a little bit about our first-time home buying process. Bella is interested in that process very much so. I understand she's looking to potentially buy her first home very soon. Exciting times. So yeah, we're going to go into this a little bit. A little bit of a different setup this time. We're going to have Bella asking me some questions for once, and I will be sharing just from start to finish how that first time home buying process really works. Bella, again, welcome to the show.
Thank you. I'm super excited. I made my first TikTok the other day talking about how I know nothing about the home buying process.
Yeah.
And so this is the perfect situation for me because I can ask you every question that I need. So I'm excited.
Absolutely. There's a lot to get into. I think number one, when it comes to first time home buying, it's about understanding this is the biggest transaction in one's life for the most part, and buying a home is a big deal. It can be overwhelming, and I think just taking a step back and going through these questions, whether you're Bella or anybody trying to buy your first home, get these questions out of the way up front. You're going to have a lot smoother of a process, and you're going to have a lot less anxiety. Take it from me, very, very important. So anyway, I will shut up. I will let you kind of go into your questions here, and let's see what we can do.
Okay, I have a ton of questions, so we'll start with segment one. I literally know nothing. Okay, so my first segment is going to be just getting started and financial readiness. I'm buying my first home. Where do I start?
Buying your first home, where do you start? Okay. Everybody kind of has a different way they want to go with this. I mean, for me personally, I'm starting with a location, right? So, and that can be a wide range. I mean, we can start with state, we can narrow it down to city, and then neighborhood, right? So that's kind of step one, is understanding where you're looking to buy. Step two would be understanding what can I afford, right? And that kind of is a longer answer there, which I know we'll get into later, but starting your location search first, trying to identify a realtor, and then also working on qualifying kind of your first steps.
Okay, yeah. So my next question is, what is the difference between getting pre-approved and pre-qualified?
So, I mean, honestly, depending on who you're talking to, they can be used interchangeably. The basic gist is a pre-approval is more or less something where you submit a loan application, it's been reviewed by a loan officer, and you're given a pre-approval letter, kind of blanket for a particular purchase price. Whereas a pre-qual is kind of like that next step where not just a loan officer has necessarily looked at a loan application, you've actually submitted supporting docs. When I say supporting docs, I'm talking your income, like for a W-2 or pay stubs or tax returns, those kind of things. And we're actually diving a little bit deeper to really make sure that you're fully approved. So a pre-qual, to me, is a next step, a more solid approval that I would strongly recommend. Listen, guys, as you shop, there are a lot of lenders out there that will just auto-generate pre-approvals for you, and it's not necessarily been reviewed 100%. So do take that extra step, because you want to make sure that somebody's actually looking at this and not just printing you a random piece of paper, giving you a ticket to go put an offer on a house and you get under contract and you're like, well, whoops. You know, don't do that. So make sure you take that extra step, get your docs in, make sure a real person is reviewing and kind of giving you that feedback.
Okay, that makes sense. And I guess we'll get into this later, but I just kind of want to know, is this a good time for me to buy a home if I'm not sure if I'm financially ready to do that? Well, are there any common red flags that can show that someone's not ready yet?
I would say there's never first of all, no, there's never a bad time to buy. You have to be at a time in your life when you're ready to settle down, for one thing. I mean, look, I don't know about you, Bella, but I've kind of traveled throughout the East Coast. I started in Columbia, South Carolina, from Charlotte, North Carolina, to Washington, D.C., to now New York, where I'm going to be spending the foreseeable future at. So when you're ready at the time of the stage of your life where you're ready to settle down, always a good time to buy.
Yeah.
For a number of reasons, namely, don't throw your money away to pay for somebody else's mortgage and a rent. So as soon as you can do that financially, Certainly, it's the right call to buy. Gosh, what was part 2 of that question?
If I were to go apply, like, would there be any red flags you'd pull from my application and be like, okay, like, maybe she's not quite ready to buy a home?
I think the biggest red flag is if you maybe are looking to purchase $1 million home and then you're going to send me documentation that might not reflect that and we're way off. On that could be maybe a red flag, or at least it starts a conversation just to kind of set expectations, but that's not even a red flag. That's really just more setting expectations, right? So for me, there aren't no red flags. It's more just, let's make sure we're on the same page of what we can afford and what we're comfortable with paying, right? And like, as soon as you're cool with that, I think a lot of those other problems or potentials and anxieties just kind of melts away.
Okay. Yeah, that's good to know. I know there's a ton of different programs out there, so can you just kind of walk me through what you think someone my age would be able to apply for?
Absolutely. So there's a few different ways we can go about restrictions on them based on the medium income in the area you're buying, but it has more lax underwriting guidelines, and generally it's a little bit better priced. So, it's a great program to take advantage of if you fit for that. Please reach out to your loan officer and see if you do, because again, that income restriction can bounce a lot of people out. But if you fit in there, is it a great product to really start with? That conventional piece is the first product. FHA is another product. Now, the difference between those two, again, I talked about the 0.5 point in the down payment, 3% minimum for conventional, 3.5 for FHA. FHA has less restrictive income qualifying guidelines.
Okay.
And generally are a little bit more flexible with lower credit score borrowers. So that's the pro for FHA. The downside, it is a bit more of an expensive loan. So you are going to pay a 1.75% premium upfront mortgage insurance premium with FHA, and that is just kind of just money that you sink, right? It gets tagged onto the loan. That's because the FHA is a government loan, and they're charging for that privilege, frankly. So although you bring an extra 0.5% down with FHA, you're paying 1.75 additional on top of your loan. So that's expensive. Yeah. It's a great product, but you want to really kind of try to fit conventionally if you can. If you're in your shoes, Bella, being a young adult looking to buy your first home and you're not rushed to do so, if you happen to speak to a loan officer and you're like, FHA is where you would be at right now, that's fine. You may want to take that extra time, build your credit score up, build your down payment up so you can afford kind of conventional. That would be certainly the best move. And on the flip side, if you need to buy a home right away and FHA is the best path forward, it's a wonderful program. Go ahead, get it. And then once you own the home, you can always refinance into a conventional program later down the road. So either way, you have options. Those are the two biggies that we see a lot of. And that's really just the beginning. There's even more than that. So.
Okay, so I don't know if this even applies to me yet because you obviously don't know my income, but are there any income limits for non-QM or DSCR loans? Okay,
so with non-QM and DSCR loans, it's a bit of a different, and I'm glad you asked the question, it's a little bit of a different, it's not necessarily for first-time home buyers, at least as far as DSCR is concerned. With debt service coverage ratio, DSCR, that's for just straight rental properties. So if you're trying to buy it as a primary, it doesn't work, but it is a hell of a program that we offer, and it's meant more for, again, investors, right? So. Okay. That, we don't look at any personal income at all. It is a frequently asked question because Beeline, we do specialize in these, right? So it is a frequently asked question, but we don't do it for primaries. We do 20-25% down oftentimes for these types of programs, but we're not looking at any personal income. Which is really, really cool. Yeah, exactly. So it's like, in your situation, it doesn't fit. However, what we are looking to do here at Beeline is to build long-lasting relationships with whether you're a first-time home buyer or a seasoned investor. And if you want to kind of be a one-stop shop or work with a lender where you can kind of canvas all of your options, that's where Beeline really thrives. So I have plenty of clients where I've started with a first-time home buying process, and fast forward 2 years down the road, we're doing DSCR, we're building their portfolio. On the flip side, there are non-QM deals that are for primary residences. So we have a bank statement loan program. It's for self-employed folks. You have to be self-employed for 2 years. This is great, not just for first-time home buying, for any type of home purchase, but it's a minimum down payment of 10% down. We don't look at your tax returns. We look at your bank statements, which if you know, if you're self-employed, a lot of times your tax returns can maybe not best represent your monthly income. So we pull that out of the equation. We add your bank statements and review, more or less we're averaging your deposits over a span of 12 months, right? So then we have an income source from here at your bank statements versus your tax returns and use that to qualify you, right? And so that's a 10% down minimum. And that's a really, really big program for us and a game changer for a lot of people. Don't think it works for you, Bella, but you're a W-2 girl, but
I am.
It's a great program.
Well, if you have money in your investment account, can you use that to get a bank statement loan, or those don't have anything to do with each other?
What it helps you with is you can pull money out of your investment account for a larger down payment. Let's say maybe 3% down or something doesn't quite work, like for the purchase price you want. You need to bring more in. And so you're kind of maxed out with your debt to income ratio. Well, you can maybe take a loan out on your 401k. You can take money out or liquidate your brokerage or retirement funds and increase your down payment size. And then you qualify, right? Because you're financing less money for bank statement, but it definitely worked. It definitely helps. Good to
know. All right, I'm going back to kind of the beginning, but I've never checked my credit. And I don't know if Beeline has like a calculator or anything through the application process, but how does my credit score affect the mortgage process? And if it's not looking so good, is there any way that I can fix it? I don't know how long it takes for you to get your credit score up or where you need it to be.
Yeah, good question. And honestly, that's a big time factor for any home buying process. So short answer, yes. Beeline, we do have an application system that will allow you to soft pull your credit right now, which is great. So for those who don't know, there's a difference. There's a soft pull on your credit and there's a hard pull. A soft pull is less invasive. It gets you the scores for a lender to review and say, okay, we have something to work with here, but it does not show up as a hard inquiry on your credit history, meaning it doesn't impact your credit scores. So what's great is we can kind of do like a little check, see how we're looking, we can get all the information we need, and then go from there. And then if everything's working, we do that hard credit check when you're either under contract or when you're ready to take that next step. So you're not getting your credit pulled all over town and ruining your score. Now, there's that. As far as what does it do to impact? Okay, again, so your credit score is going to impact which program you're going to best fit in. So again, with conventional, we want to see a little bit on the higher side of scores, right? So I would say, 660 plus is kind of my rule of thumb. We can certainly look into going under 660, but for conventional deals, that's kind of where I'm like, okay, for sure, that's kind of where I would start looking at. If you're below 660, we do have FHA options all the way down to, I believe, 580 at the moment. Fact check me later. This is, what day are we? What's the day? Is 580
the lowest?
580 is the minimum that we should go, but fact check me on that. Today's date is, whatever today's date is, we'll post later. But that can change. Now, if you're lower, there are a lot of things you can do. Like time is the number one factor to improve your credit. So if you don't have a lot of time, I usually tell folks any collections, take care of those. Don't close any accounts, but put them to zero or 1/3 of the maximum balance of your credit card limit. So if your maximum credit card balance is $10,000, try to keep your balance at $3,300 or less of the maximum limit or less. Puts you in the best possibility for improving your score. Credit bureaus do not like seeing you close to your max. Okay. So those are a couple of tips to help. I'm not a credit repair company, but I do know the basics. So and of course.
That's good to know.
The higher the credit, the better the pricing, the better the qualifying. So it's very, very important. Yeah.
And is it important to pay off your student loans before you apply for a loan? I don't know if that comes into play, but I'm interested because I have student loans to pay off. So, and I'm sure other people do too.
That's a great question.
I hope it doesn't come into play.
So the short answer is 100% no. It really depends on your situation. Like if you have to afford the house you want, it might be a red flag. Like you mentioned, that might be meaning, hey, we might be overreaching a little bit on what our affordability is, right? So if it comes down to that, I would generally say, sure, pay them off, or maybe we look at a little bit of a cheaper price range. But no, it's not going to matter too much, especially if you're like in forbearance or in deferment. We use 1% and sometimes 0.5% of your balance of your student loans as a payment towards your debt to income ratio, if you're curious. So it doesn't generally break the bank for your debt to income ratio. So no, it's not a mandatory thing at all. And I don't see a lot of folks doing that at the moment. So you should be good to let them sit.
That's good to know. Makes me feel better.
That's right.
Okay. All right. I know we already kind of talked about pre-approvals. Is it a guarantee, the pre-approval, that you'll get a loan?
With us, I would love to say the answer is yes. The fact of the matter is, when you get pre-approved, we're assuming a few things, right? So we're assuming your title is going to be cleared. We're assuming the home is going to appraise. And we're assuming that there's not going to be any changes of circumstance from the time I pre-approve you to when you close. So there's a lot of horror stories out there. We're here to tell you what not to do. And so one of those things is, what I've seen in the past is we get a pre-approval, we're ready to go, or a pre-qual even, and down the process, somebody decides to get their credit checked or they buy something, right? I've seen, unfortunately, where the pre-approval, the debt-to-income ratio was a little bit on the tighter side, meaning our approval was not flimsy, but it was tight, meaning we didn't need to see a whole bunch of changes, right, on their credit profile. Fortunately, some people either didn't realize that or disregarded that. They bought a car during the process. They bought a boat. I've actually seen people buy furniture for their new home they're buying ahead of time and put it on credit.
I feel like I would do that.
So be careful, because if you do that, if you get your credit pulled, if you get new debt during the process, we have to use that to your debt to income ratio. And depending on what that new monthly payment is, it can throw off your approval big time. So please, 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 once you get pre-approved, don't quit your job. Don't buy a boat. Don't buy anything that requires your credit being checked or deplete your assets in any type of way. Try to keep everything exactly the same from when you get pre-approved to when you close. And then, yes, you should be pretty ironclad.
Yeah, because that came right into my next question, which would be, how long does the pre-approval last? I did it and then I waited a couple months. I'd probably have to do it again, right?
90 days is generally what I'm good for. So, and that's about the expiration of a credit report is why it usually is 90 days. You got a good couple, 2-3 months to kind of do your thing before you want to, get a refreshed approval.
My next question would be, when should I fill the application out? Is this when I'm going to start looking for a house that I would go and fill it out? I don't want to have to redo it multiple times. I wouldn't really go on right now because I haven't even looked at a single house or even have a realtor yet.
Yeah, so, you probably want to apply pretty quick. Before, even if you're thinking about it, because a lot of realtors these days, they won't even really give you a ton of time without kind of knowing you've spoken to a lender first or gotten a pre-approval letter. A lot of them, these days, you can't even go view a house without a pre-approval letter. They won't even let you in.
Really?
I've seen that happen a lot. Yeah, so they're pretty serious about it, depending on the realtor you choose and where you're buying. But I've seen them be pretty tough on that. So I always say, go ahead and get pre-approved. It doesn't need to be based on a specific property. We're talking about just a general price range in a general area where we kind of know what the taxes are in that area. We kind of we know a few factors, and that way all right, I'm good at $750,000. Now I know what I'm looking for. Now I need a realtor to help me find something in that price range. So I always say, go ahead and apply first, but really before you do anything, and then go to a realtor. That's my firm advice.
Okay. What does the application look like? Is there anything I should have pulled before I even start doing it?
The application, what it looks like is it's extremely slick. At Beeline, we have a application system that really just guides you straight on through the entire process. Front to fill out the loan application, it really should be stuff that you know offhand, your personal info, roughly how much you make, how much money you have saved. And then once you complete it, then there's an upload documents section at Beeline portal. And you can upload, and you might want to prepare yourself for a couple of basic stuff, right? So for a W-2 employee, we're talking the last 2 years of your W-2s, a month of pay stubs, and the last 2 months of bank statements. That should really get us to where we need to be. And again, depending on what you're applying for and where your income comes from, that can change. But very simple for a W-2 employee. When you get into retirement income or self-employment, those income streams are a little different. We require a little bit of different documentation, aka tax returns generally. But so fill it out. You'll have no problems filling out the app. And then maybe if you have a few of those docs handy, you can upload them and get yourself pre-qual.
Okay, and is there anything that would slow the application down? If I did upload all the documents that I needed, is there anything?
No, I don't. I think as long as you know your situation, it's very straightforward.
All right, so now we're going to talk about down payment and investment considerations, because I don't know if I could get an investment property if I should just have a first home first. First question is, do I need to put 20% down? Is that if I have 20%, should I put it down or should I not?
Great question. So a lot of people think that. A lot of people say if you can't afford 20% down, you haven't saved up enough. Completely false. With a conventional deal, the way it works is if you put 20% down, all you're doing is eliminating mortgage insurance. And what mortgage insurance is, it's meant for putting less than 20% down. It's insuring the loan, essentially, right? So they have PMI companies that will insure the loan with less than 20 down. And the way it works is you have increments where that PMI or mortgage insurance decreases, and it's usually in increments of 5. So you got your 3% down, that mortgage insurance is on the higher end, then 5%, 10%, 15%, and then 20%, there's no mortgage insurance at all. Okay. So what I tell folks is review the pricing, see what makes sense. If it's 3% down and the mortgage insurance is X, maybe you're comfortable with that payment, maybe you have plans in the future for that house. Is it a long-term house? Is it a short-term house? All these things play a role. And then, of course, the most important is the final payment. What are you going to be comfortable paying monthly? Okay. So I let the final payment determine how much I'm putting down. If I'm okay at the payment with 10% down, I would personally rather put 10% down, make that payment, and keep that other 10% in my pocket, or have it remain deployed in my brokerage or retirement accounts or wherever I have it, making money for me. Right. So those things are absolutely what a veteran loan officer should be reviewing with you, and making sure you're comfortable with that payment and that down payment size.
Should I make a sizable down payment, or should I keep that money in my investments? If I can make more than 20, if I could put more than 20% down, do you think it's worth doing that? Because that make my mortgage payment lower every month?
Of course, yep. The more you put down, the lower the payment, and then the lower the payment, the more you put down, and then it's just kind of what is that payment? So it's going to be case by case. Some folks have that extra money they can bring down, and they just want to kind of have a nice cushy monthly payment that is very lax for them and easy to make. It's great. Other folks aren't necessarily in that position, or again, everybody's circumstance is different. So it's just best to review with your LO on what makes sense. But it definitely can make sense to bring more, but not always.
Okay. Can I have my first property be an investment property?
You can.
Or is that not smart to do?
No, it's smart to do. It depends. Again, it just depends on what you want. Look, if your primary situation without owning a home is fine, or it's just not in your, maybe again, like you're like me in my 20s when I was bouncing around city to city, I didn't want a primary because I didn't know if I'm going to be living there for a long time, but I wanted to buy a home. I had cash sitting I needed to buy. Buying a rental property is totally great. That's 20% down. That's the difference. Generally, it is going to be a 20% down. So you are going to be kind of forced to bring more down for that program. And then you want to be careful on DSCR. A lot of DSCR deals won't do first-time home buyers. So you have to be careful. And depending on the market, DSCR investors can turn that product on or off. Right now, I believe first-time home buyers with DSCR, debt service coverage ratio, is not really a thing, but you still have conventional. So you just, all you got to do is just you qualify with your personal income. And of course, your first time home buyer can absolutely buy a rental property. So yeah, absolutely.
Yeah, because I guess I live in Newport, Rhode Island, so it's very expensive to buy a home down there, but I know that the property value won't really go down. I would love to buy something there, but I just don't know if it's worth doing that first, or just buying something in my price range.
Yeah, obviously for a primary you need to buy, but for buying a rental property, there's a huge bias out there that people think I need to buy a rental property in the area I'm living. Mm-hmm. Not the case. You can buy wherever, right? And then you can get a lot better of a deal if you open that range out and not just buy in your hometown. So yeah, I think that's something you should check out.
If you bought something down south, I'd have to probably go down there, find it, and then who's managing the property?
There's a lot of property management companies out there, and it's really not that hard. That's definitely something to look into.
Okay, yeah, because I was going to ask, my other question was going to be, are there any signs that a property would be a good investment later? So buying somewhere that the property value isn't going to go down much, is it worth putting more into something like that?
Heck yeah. That's what investors do all day. They're looking for those pockets of those markets where the pricing is great now and they're hoping it improves and won't go down. You know what I mean? That's kind of the name of the game. So yeah, absolutely. Identifying those markets and then trying to deploy your money there on investment properties that's a great move.
Okay. All right. My next segment that I have for you is house hunting and processing tips. So my first question is, when I do start to look for houses, do you want to pick a location first and then start looking there? Or would you rather put in your price range and see what's around the surrounding areas as well too.
I think the location's the way to go.
Okay.
Location's
So
the way
pick
to
where
go.
you wanna be.
Location's going to be where you start, and then you just need to see if there's anything in your price range there, and that's where the realtors come in. Yeah, I would say establish that location. That's one way to do it. The other way is if let's say you have the location set up, but you don't know what you afford or where to begin your search once you have that location, because obviously there's many different price ranges, then you kind of go in reverse. What am I comfortable bringing with the down payment? Okay, that equates to X amount down on X purchase price, and you kind of work backwards.
Okay.
So that's another way to do it.
All right. And then are there any mistakes you see first-time home buyers make?
The biggest mistake first-time home buyers make is they neglect the pre-approval process, meaning they don't do it before they talk to a realtor, or they don't do it, even if they talk to a realtor, they don't do it until like it's time to make an offer. It's like always very rushed. So don't do that, because when it's time, when you find the house you want, first of all, in the market for the last several years, things go very quickly. So homes don't necessarily stay on the market for very long, depending on the area you're buying. That is starting to change a little bit today, but usually when you find the house you want, you're going to be like, come on.
I want it.
And so you're putting a lot of pressure on yourself and your loan officer to get everything ready and then to submit that offer. So that's the number one thing. The second is probably just trying to force a higher purchase price than they can really afford. So be careful.
Okay.
Be careful, and just make sure you're getting yourself a nice, comfortable first home.
Process.
It is a little bit stressful. So getting your documentation in up front to your loan officer is the biggest deal. Then, of course, you're going to want to have a nice realtor, a nice seasoned realtor that'll help you through that process.
Yeah.
You got movers you need. Kind of lean on them to help get yourself moved and all that good stuff. But no, I mean, again, if you get yourself pre-approved, I'm telling you, like, it's not too stressful.
And are there anything closing costs that you should put in mind when you're...
Yeah. So closing costs vary. You definitely want to hold back and plan to have general rule of thumb is like 3%, I would say, just because you have taxes and insurance you kind of prepay for up front. You got title work and appraisal. Our cost, home inspection costs, that's not required by us as a lender, but certainly something you want to do to make sure you're kind of buying a house that isn't going to cause you issues down the road. So you want to hold back some money for that, and of course you want to have some reserves. We don't want to be what we call house poor, where you put all of your money into buying the home and then you got nothing left over. So, you do want to, and then again, every state area, 3%. That's just like a really basic number. I don't want everybody to get too caught up on that. That's just kind of my rule of thumb.
Yeah.
Depending on where you're buying, it could be less. It could be even a little bit more. Talk to your loan officer about that. But yeah, know that those exist, and that you should be kind of holding back some money for that.
And is it 3% of the property value that you should be holding on to that you would pay? Roughly?
Yeah,
okay.
I mean, again, that's what I tell folks. Everybody's got a different thing, but
it's
that's
good to know.
That would be like a decent rule of thumb.
Okay.
Rule of thumb if you're just kind of shopping and you're thinking to yourself, and then after that, just go double check with your LO. But that's kind of what I do.
All right. I mean, I think that's everything I need to know to start.
I think it's a good start.
Yeah.
I think you're going to enjoy the ride. There's a lot to consider. Yeah, I mean, when you have to look inward when you're buying your first home. I find it's like, am I really going to be settling down in this town? And you just got to think it through. But yeah, I think you're gonna enjoy the process. I'm really excited for you, Bella.
Thank you.
Obviously, happy to help in any way we can here at Beeline.
Yeah, I'm definitely going to need help from Beeline. But this is great. I got all my questions answered.
Getting that pre-approval done. That's exactly right.
Getting the pre-approval done.
Good.
Okay. Well, thank you so much.
You're very welcome. Everybody watching, thank you for tuning in. Again, this is Alex at the Home Run. We have plenty more in store for you guys and have a lot going into 2026. So we're super excited in the market and for what Beeline has in store. Can't wait for you guys to tune in next time. Have a great day.
Thank you.